Today, we're talking about something that almost every small and mid-sized business owner thinks about eventually, even if they don't say out loud: the exit. And here's the twist. Exiting a business used to sound like one thing, right? You sell the company, you hand over the keys, and you're done. But that version is getting less common. More owners are choosing partial exits, staged transitions, recapitalizations, and creative partnerships. And at the same time, there's a buyer group gaining momentum that's changing the whole landscape: family offices.
I'm glad we're doing this episode because the word exit can feel so final. Like it's either I'm all in or I'm out forever. But most owners don't actually want that. They want liquidity, they want to reduce risk, maybe they want to stop working 80-hour weeks, but they still care about the company, the people, the customers. So the middle ground is where all the interesting innovation is happening.
Exactly. And before we get into who's buying and what structures are trending, let's frame the broader point. Exits are being designed, not just executed. Owners are getting more intentional about what they want from the next chapter, and capital providers are getting more flexible about how they can deliver it.
So if you're listening and thinking, I'm not ready to sell, stay with us. This might actually be about you. Because an exit doesn't have to mean walking away. Sometimes it means bringing in capital so you can keep going, but with a different personal risk profile.
Let's break down the many forms of an SMB exit in plain language. The traditional model is a full sale. You sell 100% of the equity to a strategic buyer, a private equity firm, another operator, maybe a competitor. Clean break, usually a defined transition period, and then you're done.
And the newer models are basically variations on two big ideas. 1, selling less than 100% now, and 2, separating ownership changes from leadership changes. Those sound technical, but it's very practical. For example, an owner might sell 60% of the business to take chips off the table, but keep 40% so they still have upside later.
Or they might do a minority investment where they sell 20% or 30% just to fund growth. New equipment, new locations, new leadership hires, technology upgrades. They're not exiting emotionally. They're exiting financially, partially from the risk.
And there's also recapitalizations, which sounds like Wall Street, but in SMB it often means, I'm going to refinance, bring in a new investor, pay myself some liquidity, and restructure the balance sheet so I'm not carrying the whole burden alone.
Let's talk about what's driving all this flexibility. In our view, it centers on two forces: capital needs and capital availability. On the need side, businesses are hungry for investment. Labor costs, supply chain, software systems, customer acquisition. It's expensive to scale. And on the availability side, there's more sophisticated money looking for stable SMB cash flows.
But it's not just money chasing returns. It's money chasing a certain kind of deal. A lot of SMBs are boring in the best way. They're essential services. They have recurring customers. They're not trying to be the next unicorn. And for some investors, that's exactly the point.
Now let's add the human part. Entrepreneur desires. Because even if capital is available, the exit structure really starts with the owner's personal goals. Do they want to retire? Do they want to reduce stress? Do they want to keep leading but stop worrying about personal guarantees? Do they want to pass the business to family or employees but still create liquidity?
This is where I think owners can get stuck. They think the only responsible path is either to grind until they're exhausted or sell everything and ride off into the sunset. But many owners want something like, I want some security now, and I want to keep building. That's not indecision. That's actually a reasonable strategy, if the deal is structured correctly.
So let's make it concrete. Here are a few exit flavors we're seeing more of and why an owner might choose them. 1. A partial sale to an investor where the owner keeps meaningful equity. The typical motivation is diversification. If your entire net worth is trapped in one company, that's a lot of concentration risk.
2. Growth capital without control transfer. An owner might say, I don't want to be forced into an aggressive timeline, and I don't want someone else running my company, but I do want money to expand. Minority investors can fit that, depending on the business and the relationship.
3. A staged exit. The owner sells a majority now, stays on for a few years, and then sells the remainder later. Owners like this if they care about continuity, want to train a successor, or simply want to keep earning while transitioning.
4. Internal transitions like management buyouts or employee ownership paths. Those can be powerful culturally, but they usually require financing and planning. And that brings us back to capital needs and who's willing to fund them.
Which brings us a big shift. Family offices moving deeper into SMB acquisitions. Let's define family office quickly. It's typically an investment organization managing wealth for a family, sometimes one family, sometimes a few, and they often invest with a longer time horizon than traditional funds.
And that long horizon is the key. Many family offices aren't under pressure to buy, flip, and exit within a tight fund timeline. That changes how they evaluate an SMB. They may care more about durability and culture, and less about squeezing every quarter for a near-term sale.
Now, it's not that family offices are charities. They're investors. They want returns. But compared to certain institutional buyers, many can be more patient and more flexible on deal structure. That flexibility matters for founders who want to stay involved, or who want to protect a team, or who want to hold on to a stake.
It's also changing competition for deals. 10 years ago, a lot of SMB owners had a narrower set of buyer types in front of them. Now you might have strategic buyers, independent sponsors, traditional private equity, searchers, and family offices all interested in similar businesses, especially those with consistent cash flow.
And when buyers compete, structures get more creative. Owners can negotiate for what they care about, beyond just price. Things like governance rights, decision-making control, the role they keep, how fast they transition out, what happens to key employees.
But we should put a caution sign here. More options doesn't automatically mean better outcomes. A partial exit can be fantastic, or it can be messy if expectations aren't aligned. If you sell a stake but still want to run the business your way forever, and the investor wants major operational changes, that relationship can break down fast.
So let's talk about the real center of gravity in all of this: decisions, efforts, and execution. In other words, it's not enough to say, I might want options. You need a process. And a lot of the process comes down to being honest about your capital situation.
Right. What do you actually need capital for? Is it growth? Is it buying out a partner? Is it debt reduction? Is it personal liquidity? Because those are different problems with different best-fit solutions. And if you don't define the problem, you'll end up evaluating deals based on vague feelings.
And on the availability side, you have to understand what kind of capital your business can attract. Investors and buyers tend to like predictable margins, solid customer retention, documented processes, and a leadership team that doesn't rely entirely on the founder's heroics.
Which is ironic, because many founders built their businesses precisely through heroics. But when you're thinking about an exit, full or partial, one of the most valuable things you can do is make the company less dependent on you. That's not just a buyer requirement, it's freedom for you, too.
Let's do a quick reality check for listeners. If you're an owner and you're curious about a partial exit or bringing in a family office investor, here are a few questions worth asking yourself. First, if you took some cash off the table, what would it change in your life and in your decision-making?
Second, do you actually want a partner? Not a bank, not a silent check, but a partner who will have opinions. Because even minority investors often want reporting, visibility, and some level of influence. You don't have to treat that as bad, but you do have to be prepared for it.
Third, what's your time horizon? If your ideal is, I want to be out in 2 years, that's a very different conversation than, I want to run this for another decade, but with support. Your horizon is a design input.
Fourth, what do you want to protect? Some owners prioritize maximum valuation. Others are willing to trade a bit of price for employee stability, brand continuity, or keeping a stake. Knowing your values early helps you avoid regrets later.
Now, what does this mean for the market overall? The big picture is that SMB exits are becoming less like one event and more like sequence. A liquidity moment here, a growth partner there, a leadership transition later. And family offices being more active adds another lane on the highway.
And it means owners should stop thinking of exit planning as something you do at the end. It's more like building the business so you have negotiating power whenever you choose to transact. Even if you don't sell for years, you're creating options.
Let's land with a practical takeaway. If you're a founder thinking about any kind of exit, full, partial, or phased, your best next step might be to map 3 things. What you want personally, what the business needs financially, and what kind of partner matches both. Those 3 are the triangle that determines whether a deal feels like relief or regret.
And if you're hearing family office and thinking it's out of reach, remember, many family offices are actively looking for SMBs where they can be a steady, long-term owner. If your business is stable and well-run, you might be exactly what they're looking for.
The exit landscape is changing, but the core question hasn't changed. It's still, what do you try to achieve, and how do you structure a path that gets you there? More creativity is available now than ever, if you're willing to approach it as design, not destiny.
That's it for today. If this sparked questions, like what a partial sale could look like in your industry, or how family office deals differ from other buyers, keep the conversation going. The more you understand your options, the more control you have over the outcome.